What's up, guys? Welcome back. One of the easiest ways to make passive income trading options is to sell options, right? To sell calls and to sell puts. And about a year ago, I made a video about selling the cash secure put or the cash covered put. So many people have been reaching down into the comments section and asking me, like, is there an update video? I did do an update on the covered call. Am I going to do an update on the cash secure put? Well, here it is. There's definitely some things that I could talk about in the last year that I've learned, or questions that people have consistently asked me over and over again. I do have a ton of videos on trading options for beginners. I'll leave them like linked all over the place down in the comments and the description and things like that. But I wanted to dive into Robinhood. That's the platform I'm going to be using right now. I do have some options videos coming up with Fidelity because I started trading options there. But a lot of people using, the nice, easy platform here on Robinhood. So I'm going to show you how to do that. Discuss certain things you should be looking for. Discuss things like, when do I start with a cash secure put over a covered call, when I'm trading the wheel strategy, and just basic things that you should understand moving in as far as premium, strike prices, what to pick, expirations, and like I said, some of those Greeks. And I'm actually going to make one right now. It is Friday. I've been planning on making one, so I haven't made a cash secure put actually in a while, so I'm kind of excited to do so. And we're going to collect ourselves some passive income right now, and then I'm going to use that money. I'm going to go buy a beer because it's Friday. Okay, so right here is my Robinhood portfolio. I use it strictly to trade options. That's all I use this for. You can see right now, over the last year or so, I've been doing a lot of leaps options with covered calls. That's the poor man's covered call, or a diagonal debit spread. That's a lot, but when I first started, I started with just the wheel strategy, just selling calls and selling puts. So what does that mean to sell a call versus sell a put? Well, in every options contract, there's going to be two parties, right? You're going to have the buyer of the option and the seller of that option. When you sell something, you get some money in return. When you buy something, you give up some money in return. So when we are selling puts, we are going to sell that options contract to a buyer, and they're going to give us some money, and we call that money premium. Why is it called a cash secure put? Well, because I'm going to require some collateral. I'm going to need the amount of money to buy 100 shares in order to do this. If you don't have that, it's called a naked put, a little bit more risky, not really for beginners, but you can do it. But in every transaction, there has to be the collateral. When we sell calls, the 100 shares is a collateral, and you could check that video out if you haven't seen it. But here, we are going to need the amount of money as collateral, which I'm going to show you. So when will I sell a cash secure put as opposed to a covered call? It really depends on the stock and that day. So the stock I'm going to choose right now is Vuzi. If you've been following along, you guys know I love Vuzi, and they've been taking a little bit of a hit recently. So that's why I'm going to go the cash secure put. I sell puts when the stocks are red because the premiums are higher for puts on the days that stocks go down, because the buyers want that to go down, so the premiums are higher, right? It's all in reflection of what the buyer wants. In a put, when you buy a put, you want that to go down, premiums go up, good for the buyer. But when we're going to collect premium, that's also good for us. If I would have logged in and seen Vuzi was on a climb, then I would have bought 100 shares outright and then sold a call, because calls pay more premium on green days. So like I said, with this last week or so, it's down 16%. So I know, and this is a great price, a stock that I want to hold. You need to want to hold 100 shares of a stock. Don't chase premiums. That's greedy. This is a stock that, if you look, I already have 2 call options with them. Very bullish on this stock. So don't just be chasing premiums. Think about a stock that you want to own. The beautiful thing about it at being at $14 is I can make a strike price right around that, and I'll explain what the strike price is, and my collateral is going to be that strike price times 100. So if I were to say make a $14 strike, which I am going to explain, then I would have to put up $1,400. So here's what you're going to want to do. When you have Vuzi open, you have over here invest, blah, 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 and then down here, trade options. If you're new to Robinhood, you have to enable level 1 options capabilities. You have to read some disclosures and make sure that you understand the risks and rewards of trading options, because this is a risky practice. So I'm going to click trade Vuzi options, and that's what's going to bring up something called the options chain. Now, if you've never seen this before, it can seem wacky. It can seem all over the place. It's really a lot simpler than it looks. We have a couple things up here that we have to understand. We have buyer and the seller, the two counterparties. We want to make sure that we are on the sell side, okay? Next, we could sell a call or a put. This video is about the put. So that's the first place we want to start. Next, we get to choose our expiration date. Now, for us, I like to use my expiration kind of short, less than 30 days. Why? Because if we want to get a little more technical, there's something called the Greeks, and one of those Greeks is theta. And what it does is it eats away the value of that option over time. And the closer we get to expiration, the faster it does so. When we sell an option, we want the value of that option to go to zero. We want it to expire worthless. And I'll show you what I mean by that in just a second. The other things that are worth noting, okay, the strike price. This is the price that you are willing to buy 100 shares at. That's what we're doing. When we sell this contract, we are going to be obligated to buy 100 shares at the strike price that we choose if we are assigned. And what assigned means is if Vuzi falls below my strike, I will get assigned. If it falls to $11 and my strike is 14, I will have to buy 100 shares of an $11 stock for $14. That's a $300 difference, and there's where the risk comes in a little bit and why you have to choose your strike price pretty accordingly. Now, for me, I kind of want my strike price to be close to the money because I will take Vuzi for $14 all day. Now we see over here the price, the premium. That's how much the option's value is worth, right? That's how much we are going to collect in premium. Right now, today, July 16th, all of these pretty much worthless. The trading day is about to end. So what I'll do is I'll go, this particular stock only trades monthlies. Some do weeklies, some do monthlies. So I'm going to click August 20th, and then I'm going to come up here. And right now, if I am willing to pay $114 for this stock, I can get myself $153, and I'm going to do so. So to do that, I'm going to click this plus. Then I'm going to review everything, right? Because sometimes we rush and we buy an option instead of selling an option. That sucks. So I'm going to sell a put. This is called a short put. Total credit that I'm going to get, money in the bank, shorty, what you drink, I'm going out for a $150 bar tab. This goes into your buying power immediately upon fulfillment. Immediately. It does not show and reflect in your portfolio value until the option is closed, but you get that money right away. It is yours. Robinhood is also now doing an amazing thing. It shows you what your profit and loss is. The max profit you can get on this option is $150, the premium that you collect. The max loss, it really just depends on the capital gains. Really, your loss is unlimited, while on a cash secure put side, it could go down to zero, so you can lose $1,250. If you had to buy a $14 stock that was worth nothing, that would not be good. The break even, so it shows you all this stuff right now. But for me, I'm thinking to myself my two scenarios. One, it expires worthless, meaning that on August 20th, the share price is above $14. I get my collateral back and I repeat. Or it drops below $14 and I'm going to have to buy 100 shares at that $14 strike price, $1,400, and then I'll sell a covered call against it and continue the wheel strategy. So I'm going to press continue now. Now, before I do that, let me just go into the Greeks here real quick and show you some things that I might think about. I talked about this Vega, right? I mean, this theta right here. So that's how much the value, this $153, is going to decay every single day. I made a video about the Greeks. You should definitely watch that video. I'll put it up in a card or I'll link it somewhere in the end of the video. And then this delta, this 43% chance, this gives me a rough estimate on how much chance the buyer has of being successful. So they have a 40% chance of being successful. That means that I have roughly a 60% chance of this expiring worthless. Like, I'll take 50-50. Like I said, if it was a green day, I'd buy this for $1,400. I'd buy 100 shares of it right now, but that doesn't matter too much. We see right here also the 153. It's going to round down, and I'll show you the bid-ask spread and what you need to be looking at for that as well. So when I click continue now, it's going to give me my contracts. I want one contract, 100 shares. I enter a limit price. Okay, so that is this price right here, but it's times 100. So we can do 150. This is called the bid-ask spread. I also do a video on the bid-ask spread. Check that video out in the description and in the comments down below. Like I said, I've made a bunch of videos on this stuff. If you want this to be fulfilled fast, you need to come down to the bid buyers. That's at 140. Or if you don't want it to sell, or you probably won't, you come up to the sellers. The sellers are selling at 160. What I'm going to do is I want this fulfilled really good. I'll take $145 instead of $100 just to knock this out and get it fulfilled. When I press review order, because I am at the bid price, it should fulfill pretty much immediately for me. You could try that 150, wait a little bit, see if it fulfills, get yourself $5 more. Like I said, I kind of just want this done so I can head to happy hour. I'll take the 145 instead of the 150. So I'm going to click review order. It is going to explain everything. Here's the collateral, that strike price times 100. Here's the credit I'm going to receive. You are agreeing to buy 100 shares of Vuzi at $14 on or before August 20th. If you aren't asked to buy Vuzi by then, you'll keep your collateral and the full 140. Boom. Okay, this is fantastic. Submit, and then we'll see if that fills. And we see right here, guys, it filled pretty much right away. If we click into that, we will be able to watch that. This is just going to be the value of that option as it changes over time. I'm not really worried about total loss, total gains. But what I will say is I will probably set a limit order to buy to close this at about 75% of the value. I probably won't let this ride out. And because I've never really showed that process before in any of my videos, I'll show exactly what I'm talking about. I am okay taking 75% profit and getting out, right? That's okay with me. So what I'm going to do is I'm going to set a limit order for buy to close. Now, 25% of 150 is what, like $32? Let me check that. It's $36. So what I'm going to do is I'm going to put 0.636. So that's going to be $36. If the value of this option, which right now is at 150, drops down to 36, this will buy to close. I'll give $36 back and it'll be closed. A little bit more advanced strategy, but you should definitely be looking to close your options and not let them get to expiration. When we sell options, whether they're calls or puts, we want to make that option, collect that premium, head to happy hour, and then when we're happy, 75, 50%, whatever you want, lock it up, take that money back. So many times I've watched people get greedy for $36 on 150 and then this thing tanks or it doesn't do the right thing. And trust me, find a percentage that you're happy with collecting the full premium and then just set a limit order, buy to close or watch it. Do whatever you have to do and that will be good to go. And then I'll review this order and that's going to stay open for a while because it's not going to hit $36 till we get to much closer to expiration. I'll leave an hour and 44-minute video on trading options for beginners. I'll put that right up here. I've done that over the last year. And then I'll throw some other videos that are relevant. Definitely check the pinned comments down in the comments section below. If you have any comments, let me know. Tell me if you like the video. Give me some feedback. Let me know if there's any other videos that you want me to make in the future. If you're new to the channel, consider subscribing. Give this video a thumbs up. And until I see you guys in the next one, stay positive. Work really, really hard always. Please be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.